joining our webinar this morning. My name is Mike Fiffick. I am the partner. I own my law firm called Fiffick Law Group. We're in Pittsburgh, Pennsylvania, and we are the proud provider law firm for Legal Shield for members in Pennsylvania and any members outside of Pennsylvania who need to talk to us about a Pennsylvania-related matter. We're hosting a series of webinars this year on a variety of topics, and many of those will be business-related. We have partnered with the Donnelly Boland and Associates financial services firm. Matt is here and Noel are here, and they're going to be our presenters today. Matt will be our sort of technical host and guru. Noel's the brains of the operation and the looks, as so happens to be, right? But we've worked with Donnelly Boland for 25 years, and they're a financial services firm here in Pittsburgh. They're not limited to working just with customers in the Pittsburgh area. They provide accounting and bookkeeping and tax, HR, and a wide variety of business consulting, marketing, communication services. They provide a lot of services to small businesses and people who are independent contractors. Folks just like you all are independent business owners. And today we're going to be talking about sort of year-end accounting practices, business practices, sort of taking stock of your year-end and getting ready for 2021. And it's not too late. We're in 2021. We're in January, but it's really time to do all of those things. Get ready for tax time. So Noel, who is a CPA at Donnelly Boland, is going to take us through and be our primary presenter. So with that, Noel, I'm going to hand it off to you.
Okay, excellent. Thank you, Mike. It's been a really nice partnership with you presenting these seminars. And for those of you that joined us in November for our Accounting 101, welcome back. For those of you that are new this morning, welcome. I do like to put a disclaimer, just because I am a 100% accounting nerd. I get very excited, very happy to talk about accounting. I hope that some of you can see today why accounting can be some fun, maybe at least. So I apologize in advance if I get a little too happy when we talk about accounting matters. So with that, we're going to start.
And Noel, while you're getting that up, I want to put just a brief programming note in.
Yeah.
If you like this webinar, we will make it available on our YouTube channel after it's all done. And we are going to be doing another webinar. Our next one, Matt, is March 5th, I think it is.
I thought it was March 4th, the Thursday.
March 4th, Thursday, March 4th. We're going to be talking about tax elections for small businesses, meaning what tax status is right for your small business. And we'll be talking in particular about the S tax election, right? You may have heard about an S corporation, but it's not a type of a corporation. It's a corporation that is elected S status for tax purposes with the federal government. We're doing that on March 4th because March 15th is the deadline every year for a business entity to elect S status
feel bad
for that year. So if you're interested in tax status, that's something that a lot of business owners ask us about all the time. You'll want to definitely join us on March 4th and tune into our Eventbrite page, Fiffick Law Group. I'll also post it in the Small Business Associates group as well and on our social media. So with that programming note, back over to Noel.
Just making sure. Do you all see the slides on my screen here? Perfect. All right, so as Mike mentioned, we're going to be talking about year-end accounting and reporting. And am I having a delay? It doesn't want to seem to move forward. There we go. So, our agenda this morning, we're going to be talking about year-end accounting and how ensuring your transactions and reconciliations that you get in place for year-end is going to help make sure that you're ready for your tax compliance. Also for any other third-party requests that can come your way, and how important a checklist or tracker sheet is. And this could turn into a typical monthly close or quarterly close, which helps save the time then at year end. We're also then going to talk about 1099 reporting. So the month of January is the hot month for 1099s. We're going to talk about the 1099 miscellaneous, which for 2020 reporting did have some changes, so we'll talk about those. We are going to stay from a federal perspective on that. So there are some different state requirements. We will not get into those on today's seminar. We're then going to move and just talk briefly about deadlines and timing of the W-2s and W-3s and kind of what is all involved there, making sure you have the timing and deadlines noted. Moving next into the ACA reporting. So this is going to be your 1094Cs and your 1095Cs. And those are some new forms that have been around a couple years now related to the Affordable Care Act. And then we'll wrap it up, make sure we continue to share some high-level key takeaways from today's seminar. And then we'll have some time at the end for Q&A. Both Matt and Mike will be monitoring the chat pod. So if you have a burning question, please put it in there, and we can have discussions. If there's something that needs to be discussed right at that point, we will discuss it then. Otherwise, we'll have some time at the end to chat about any questions you may have. So diving right in, calendar year comes and goes, 12/31, and most people in the business world, their attention automatically thinks of taxes. Taxes are a necessary evil. Most people dread them or hate them. Best case, you mildly tolerate them, but they are so important from a filing and compliance perspective. You definitely want to stay on top of that. And things we talk about today are going to help you ensure that you have that confidence that you have a good, clean set of records and you're ready to file timely and efficiently. And just so you're aware, we're going to be referring to a business annual cycle, which is 12 months, typically a calendar year, but just, we're going to be focused on that today. But you can have a fiscal year other than that ends other than 12/31. But the timelines we're talking about and the deadlines we're talking about, when they're IRS driven, they stick kind of regardless of what your accounting year end will be. So what are you going to do first? For year-end accounting, you want to make sure that your asset and liability accounts are reconciled and tie out to third-party support. So what am I talking about here? I'm talking about your cash or bank accounts, your credit cards, your loans or lines of credit, assets and liabilities where you have a lending institution or a bank that has a statement or something that you need to tie out to for that year end. If you have online capabilities with these institutions, fabulous. Log in, pull down those statements, and get to work. If you don't have online capabilities, you definitely want to reach out to those institutions and request a copy of your statement. If they can give you a full year transaction history, even better. That will help you in this. By reconciling your accounts, you're making sure that every transaction that occurred throughout that annual period is posted, and it's posted accurately, which is very important. When you have erroneous postings and they're sitting in an account that is incorrect, that could lead to questions, maybe from a tax perspective, that you don't want the IRS to start questioning things. You never want to open that door for a potential audit. But if you've reconciled everything and you've ticked and tied it out, you can have that confidence that you're good to go. Once those types of accounts are reconciled, you want to run a trial balance or general ledger report from your accounting system. So a trial balance is a listing of your ending balances of every single account that's in your chart of accounts. And what is that ending balance? If you're running it for the end of the year, in this case 12/31, you will see all of your assets, liabilities, income, expense, and equity accounts, and what their ending debit or credit balance is as of 12/31. That's great. And a trial balance, the best part of it is it should balance. Your total debits should equal your total credits. It should go to zero. If you run your trial balance and it doesn't go to zero, you know you have to do some digging and research. Maybe a one-sided journal entry got posted by accident. Maybe a new account got added into your chart of accounts, but no one checked the box to get it to flow through to your reports. So having that trial balance in front of you is going to help you determine, do you have anything missing, and a correction is necessary. The trial balance is also going to be able to help you determine, does something just not look right? So every single account in your chart of accounts has a natural debit or credit type balance. So for example, assets, those items that your company owns and has a value to your company, those should typically be in a debit position. They have value, they're an asset. Whereas on the flip side, your liabilities, those are things your company owes to a third party at some point in the future. Those should have a natural credit balance. For example, say you have a prepaid general insurance account, and that indicates that you are paying your general insurance liability a month in advance. That's going to be a debit. If you run your trial balance as of 12/31 and you see that your prepaid general insurance account has a credit balance, that's going to trigger that, what happened here? Did we not pay this bill? Did we not prepay it? Or was there maybe just an entry that got posted to the prepaid account incorrectly? Both of those would indicate that a correction needs to be made. The one, just a reclass journal entry needs to be posted through your ledger. The other, you're going to want to reclass that to an accrual account to reflect it properly in your financials as of year end. And how are you going to know how to dig and where you're going to research? That's your general ledger report. So your general ledger report is a listing of all of the detailed transactions that occurred in your business for that time period that you select. We're here discussing the annual cycle. The general ledger is going to show you all of the debits and credits, and it's going to give you every single piece of information you need to do your research. And it's between the trial balance and my general ledger, I can't decide which one's my favorite because they're both fabulous. They just tell me how business did, and they make sure that I have posted everything correctly. So you have your trial balance run, you have some general ledger details. What's next? You have to take some time and review your income and expense accounts. You want to look at your expenses to ensure that you've used the same accounts consistently for similar expenses throughout the year. Wireless phone expense is a great example of this. This is something that is typically going to be a monthly recurring expense of about the same amount. If you're looking at your wireless cell phone expense account details and you see different amounts, you see weird amounts or no amounts, maybe something's missing for a month or two, that's an indicator that either A, you didn't pay your wireless bill, and that can happen, or B, it got posted to a different account and maybe it's incorrectly increasing your workers' comp insurance line. Those general ledger details are going to help you dig into these discrepancies and be sure that your expense accounts have fallen out to your expense transactions have fallen out to the correct expense accounts. You're also going to take this time to ensure that your revenue recognition, what you're showing as your sales or income for the year, makes sense. Do they align with your accounting policy? And just as important, do they align with GAAP guidance? So GAAP, generally accepted accounting principles, dictates how you can recognize revenue. And in formal language, revenue recognition is going to identify the specific conditions in which you can recognize revenue and determine how to account for it. In simple terms, you can't recognize revenue until you've actually done the work, incurred that cost or expense for the revenue, and you can measure it with a dollar amount. The other piece that GAAP has added into revenue recognition is, do you expect this amount to be collected? 99.9% of the time, obviously you're not going to do work with a customer unless you expect to collect that in cash. but you do have to consider that. So as you're reviewing your income accounts for year end, you want to make sure, have I done anything weird in my revenue? We definitely don't want to be sliding revenue back and forth between years to try to take advantage of some special tax forgiveness rule or some financial reporting or debt covenant with your lending institution. You need to make sure that revenue recognition is occurring based on GAAP and that you are matching your revenue with your costs. It's very important. At that time, again, do you have corrections or adjusting or reclass journal entries to make? Go ahead and make them right in your ledger in your accounting system. This is also a good time to make sure that you have no personal expenses mingled in with your business. So when you started your business, and as we talked about in November, you want to separate your business and personal bank accounts, but hey, I know it's easy to pull out that wrong card when you're out to dinner or you're on vacation and you're having a fabulous time. I would be in Disney World to Via Napoli and Epcot. You might pull out a wrong card. If you see a $600 charge to Via Napoli, it's probably not a business expense. You definitely want to clean those out, and this is the perfect time to do it so that you're not taking some personal deductions on your business filing. All right, so you've reconciled your assets and liabilities as they relate to third-party support. You've done a very detailed review on your income and expense accounts. Next up, your accounts receivable. So your accounts receivable is your balance of items that customers owe you that you have not yet been paid for in cash. So what do you want to do at year ends? You want to run your AR aging report from your accounting system. This aging report is going to help you determine, do you have maybe some problem accounts, or do you just maybe have some clerical issues that just need tidied up for the year end? At this time, you're going to want to offset customer credits with outstanding invoices if applicable, and net down the balance owed, the actual outstanding balance owed from the customer. You're also going to want to try to clean up some older accounts with your customers, send statements, make collection calls, things like that. You definitely want to get that cash in the door quickly, but sometimes things just happen where a customer just hasn't paid yet. This is also the time you're going to want to take a good hard look at those receivables and determine, do you need to write anything off? Is there bad debt expense that you need to show here? You're seeing on your aging, you sent a $5,000 invoice for a project back in February of 2020. It still is showing as outstanding on your aging report. You've called the customer, the number is disconnected. You've sent a couple emails, they're coming back as undeliverable. It's a pretty good indicator you're probably not going to collect that $5,000. You want to write that off because if you don't and you keep it out there, you're continuing to recognize revenue that really isn't collectible, and it's going to not allow you to have those good, solid, clean accounting records that are so important from both a financial reporting and a tax reporting perspective. You're also going to want to make sure for year end that you have all of the invoices that you've sent to your clients or customers readily available. If you're already sending electronic invoices, fabulous. They're already there for you and they're probably already saved in your account. If you're still sending paper invoices, no problem. You can either scan and save those as an attachment in the transaction level detail of your accounting system, or just make sure that they are filed and in order so that if there are any potential questions, you can get your hands on them pretty quickly. So we talked about AR. We're going to do a very similar process with accounts payable. You're going to want to get your aging report run. It's going to show you, do you have any items that are severely past due that you owe to your vendors? At this time, you're going to want to offset your vendor debit memos with outstanding invoices if you need to. And you're also going to want to try to clean up those older accounts with your vendors. Sometimes when you're doing a check run, a whole vendor could get unchecked or checked off as saying do not pay just for for that 1 week. but then they never get rechecked. And so that invoice never gets paid. Making sure to do this review on at least an annual basis allows you to keep that flow of communication with your vendors open. Things get lost in the shuffle. Things can fall out into that email ether limbo location. So you can reach out to your vendor, find out, hey, do I actually owe you this $1,500 from 6 months ago? I really apologize, but it slipped through the cracks. And your vendors are going to appreciate you reaching out, taking that time, and it makes sure that you have a real accounts payable balance as of the end of the year. Matt, is there a question?
Yeah. If you write off debt, is there a 1099 type report that needs to be filed with the debtors and the IRS?
Oh, that's a good question. There is a debt forgiveness form. I am not 100% sure under which rules you would have to fill that out. I would definitely like to be able to do some research with our tax team and get back to you on that if we can. But yes, there is a form, and under certain circumstances, you do have to do that. But usually in the cases of when a company is out of business or things like that, there's no place to send it.
Just a quick follow-up on the topic of debt forgiveness. PPP loans from the federal government are forgivable loans, and they are not taxable from an income purpose. So if you apply for a PP loan and you follow the rules, you never have to pay the loan back, and it is not recognized as income to the business. So as long as you follow the rules, it's like a grant. It's what it's intended to work out as a grant.
And Mike, to follow up on that too, you kind of get a double bonus because you're allowed to take those expenses as business tax deductions. Normally, if you're not allowed to recognize the revenue, you also can't recognize the expense. So you do get a double benefit there from a tax perspective.
That was some good news that was clarified.
Yes.
In late November or December, the Treasury had indicated they weren't going to let businesses write those expenses off, which would have ended up reducing the benefit of the loan by about a third, but you can write them off. So it basically works as a complete grant. So no reason to not apply.
Absolutely. Absolutely. Take advantage when you can.
Yeah, and then there's a follow-up with that. Should the debt write-off apply to the date the debt was created or when it was written off?
You will have to write it off at that point in time. So you definitely don't want to backdate anything into a prior period. So if you recognize the revenue in May and then you're writing it off in December, that write-off is going to be reflected in your December financials.
To this moment over the course of the past couple of weeks. And it's part of why I think
Is that a question, Matt?
I'm trying to figure out, I think somebody's not on mute right now. So if everyone could check if they're on mute, that'd be great. Thank you. There we go.
Beautiful.
Okay. You're good to go.
All right. Excellent questions. I love the interaction. Thank you. Okay. So we have our assets and liabilities reconciled. We've taken a nice deep dive on our income and expenses. We've cleaned up our accounts receivable and accounts payable. What's next? Our tangible assets. So this relates to inventory and fixed assets. So maybe you don't have inventory in your business, and that's fine. If you do, you definitely want to physically count these items to ensure an accurate balance for year end. Maybe you do cycle counts throughout the year where you're taking certain types of items and counting them as groups and reconciling that throughout the year. That's great. That might actually take the place of a full physical in certain cases. But if you're not doing that and you do maintain inventory, you want to have a good ending inventory balance. The key thing behind having really solid, accurate inventory counts is your cost of goods sold is determined directly from your beginning and ending inventory balances. So just real quick for an accounting formula, you would take your beginning inventory balance, You would add to it all of the goods you purchased for sale, and then you would subtract out your ending inventory, and you're left with what you will be recognizing as cost of goods sold for that period. For people that maintain inventory, typically cost of goods sold makes up a significant portion of your expenses and your costs of your business. Having an accurate beginning and ending inventory balance is going to ensure that the cost of goods sold that you're recognizing, which is ultimately what you're recognizing your revenue on as well, is also accurate, and you can rely on those pieces. You're also going to want to look at your other tangible assets. So these are typically going to be the assets that you have capitalized throughout the year. So your fixed assets, pieces of equipment, a fleet of vehicles, things like that. You want to make sure that your fixed asset register is up to date. Take a look around. Do you have a trailer in your manufacturing yard that isn't on your register? You better make sure you get it on there, because A, you're going to get a tax benefit for it, especially if the bonus depreciation rolls keep sticking around for us. But B, there's a tangible value there. There is more value in your business with that asset. You want to get it recorded on your books. On the flip side, maybe you had that trailer last year and you sold it because you were thinking about buying a better trailer for next year. If that trailer no longer exists, you want to make sure that any fixed asset disposals have been recorded correctly. At this time, you also want to make sure any supporting documentation is readily available. Did you buy that trailer? Did you finance that trailer? Get that loan support documentation together. Make sure that your fixed asset register includes things like the date of acquisition, describe the property you acquired. Make sure you have the correct amount, including any delivery fees or taxes. Those can all be included in the cost of that piece of equipment or vehicle or other tangible fixed asset. That is going to help immensely for tax preparation. This is also the time you want to make sure, if you do have fixed assets or other tangible or intangible assets, have you recorded depreciation or amortization expense for the year. On your trial balance, if you see those accounts have big zeros, and if all of your assets are fully depreciated, you're good. If you still have a value on those assets, there's going to be some depreciation and or amortization that needs to be recorded. This is the time to check that and make the related entry as necessary. You're also going to want to take a look at your payroll and payroll tax liabilities. If you reconcile these to what was reported on the quarterly filings to the taxing authorities, it's going to help immensely when you're filing your year-end forms, like your W-2s, your W-3s, and your final quarterly 941. Any difference needs to be investigated. Maybe it's something as simple as when those entries got posted to your ledger, just an incorrect account got used. Easy peasy. Make a reclass journal entry, you're done. But it could be that there was some type of change that happened after the fact. After you sent in that 941 for the quarter, something changed with those numbers. As you know, the IRS and any other taxing authority loves to assess penalties and interest. So you find these differences, you want to take care of filing an amended return or form as quickly as possible and ask for abatement, if it's a first or second time offense. But absolutely, this is the time to do it. We've talked about a lot of stuff you should do. Reconcile your assets and liabilities, clean up your AR and AP, review your income and expense accounts, take a look at your tangible assets, and make sure your payroll and payroll liabilities are lining up with what you reported to the authorities. How do you keep all this on track? You have an overall checklist or tracker. This usurps the general ledger and trial balance for me. I love tracker sheets. I love checklists. I love documentation. And every accountant and tax person is going to tell you the same thing. If anything you can document is going to make everyone's lives so much easier. If you don't already have an official checklist or tracker file, go ahead and use the trial balance as a starting point. You'll be able to document any issues you've come across during your reconciliation process. You can initial and date stamp that when you resolved it or completed that review. This is also going to help you get on track for a solid monthly or at least a quarterly closing process going forward, which is going to help alleviate that stress of doing all of this only at year end. This is also going to, when you document those issues, it's going to help you not make those same mistakes in the future. You can use it as a proactive learning tool. And the last and most important thing is it's a resource tool when gathering your documentation for audits, tax compliance, bank requests, etc. You know that you have done your due diligence, you've taken a look at everything, you've scrubbed those accounts, you have that confidence that you have everything ready to go for those types of questions and queries. So wrapping up this segment, why is year-end accounting so important? It's going to ensure your accounts are reconciled and tie out to supporting documentation. It allows you to run reports and do analysis and ratios on your company that you can be sure the data is complete and accurate. Once you know your transactions are posted and everything is clean and in order, your financial package is going to be perfect and spot on. So when you're preparing your income statement, your balance sheet, your cash flow statement, your statement of changes in owner's equity, you know that complete financial package, which is the basis of the support for your overall federal tax filings. It's accurate, it's clean, and you're ready to respond to those questions from your tax accountant, or if you need to, from the IRS. You have that confidence. Plus, that analysis and ratios that then you're doing on your annual business cycle mean something. They can help you budget and forecast going forward, help you make more well-informed short-term and long-term goals for your company. So year-end accounting, super key, and hopefully these practices you can put in place into a monthly and quarterly process to kind of spread those pain points out over 12 months instead of just at year end. So we talked a lot about accounting. These next few sections, we're going to be talking a lot about form numbers, deadlines, timeframes, things of that nature. As I mentioned when we covered the agenda, we are going to be focused on the federal filing specifics. 1099s alone and W-2s alone and ACA reporting alone could fill a whole seminar, by themselves. So we're trying to just give you the highlights to make sure you know what's expected, when is it expected, and how important they are. So 1099 miscellaneous forms. These are tax forms that are governed by the IRS, and they're required to be filed on an annual basis to each organization for whom you have paid in excess of $600. So one good piece of news, if you've paid all of your transactions via a credit card and not by cash or check, you have no 1099s to report because the credit card company will actually be responsible for processing those 1099s to those vendors. If you've paid by cash or check, though, to an individual or an LLC, you do have to file a 1099 for them. Now, also, if you've paid to an organization that is incorporated, you don't usually have to prepare and file a 1099, but there are some notable exceptions, and those are any amounts you pay for rents, medical and healthcare payments, or payments to attorneys. So regardless if they're, a C Corp, or ABC Company Inc., that you have your monthly rent that you pay to, you do still have to provide a 1099. There's also, just so you know, there's tons of 1099 forms out there, 1099-G, 1099-R, 1099-SSA, there's tons of them. We are only focused on the miscellaneous forms for today's discussion. So, new items for 2020 reporting. This was a major change, one of the few changes for 1099 miscellaneous that I've seen in recent years. The 1099 miscellaneous was broken out to two separate forms for 2020 reporting, so it is effective right now. There's the 1099 NEC, which is for non-employee compensation, And these are due to both your recipients and the IRS by January 31st, 2021. The 1099 miscellaneous, which is for all the other boxes that used to exist only on the miscellaneous form itself, these are also due to your recipients by January 31st, but you have a little more time to file to the IRS. You have till February 28th if you're filing by paper, or March 31st if you're filing electronically. So this new form, what is it? 1099 NEC is used to report non-employee compensation. So these are going to be amounts that you've paid to independent contractors, self-employed individuals, or gig workers. This used to be what you put in box 7 on the 1099 miscellaneous form, but now it's a wholly separate form for 2020 reporting. Attorney fees are going to go in box 1 of this form, kind of regardless if they're an individual or not an individual or not an LLC. The 1099 miscellaneous, this is everything else. Typically, they relate to rent, legal settlements, or prize winnings that you've paid to individuals or LLCs. But this is also where you're going to report any medical or healthcare payments that you have paid to any organization in excess of $600 for the calendar year. Just some other filing notes to make sure you're aware of. If you're filing your 1099s by paper, you also need to submit the Form 1096. This is not necessary if you're filing online, but the 1096 is that summary transmittal sheet, kind of like the cover sheet. So the IRS has that when they're processing your paper 1099s. If you're filing your 1099s online, that is done through the IRS FIRE system. But there is a form you have to file to be allowed to use that system. The form is 4419, and that form has to be filed with the IRS at least 30 days prior to the deadline. So for 2020, if you have not filed that form, you're going to need to process them manually. Matt.
One of the questions that comes up right now is, does Legal Shield qualify as an attorney fee? I think that's gonna be for Mike.
Yeah.
I don't think so.
Okay. We also had another question about W-3s.
You're probably paying with your credit card anyway, right?
So you're good.
You don't get it.
We also had another question about W-3s and 941s, but as we're going over all these filings, I think that you cover.
Yeah. That'll be our next section. Yep.
Yeah, that's why I didn't stop for that one. You're good.
All right, excellent.
I think there was a move afoot several years ago by Representative Tom Cole, who's a congressman from Oklahoma, to try to get the Legal Shield premium as a deduction. I don't think that ever has been successful, at least not that's been communicated to me. So that would certainly be big news. Might be deductible for businesses, I would guess, certainly, but not for anybody.
Perfect. And for the 1099 NEC, there's also an extension you can file. If you think you can't get them to the IRS by January 31st, there's a form 8809, that's an extension form, but you still need to send to your vendors or recipients by the 131 deadline. This extension is only for the IRS filing. All of these forms are readily available on the irs.gov website. If you just type in 1099, 1096, 4419, they're going to pop up and be available for you to review. So preparation of 1099s. The key thing about 1099s is you need to have a W-9 for all of your vendors. This is going to help you determine if a 1099 is even necessary. What is a W-9? A W-9 is governed by the IRS, again, our favorite friends, and it's a request for a taxpayer identification number and certification by the vendor. So essentially, it's a one-page document that the vendor is going to fill out their name, address, taxpayer ID, and check a box as to what type of organization structure they are, and then they sign and date it. It's easiest to get these when you're setting up a new vendor, but you can also request these at any point that you have that relationship with the vendor. Please note, if the vendor refuses to provide W-9 or has omitted information, the IRS says you can withhold 28% of that contractor or that vendor's pay and send this amount directly into the IRS. So this is considered backup withholding. The IRS is using the 1099 forms to match up those taxpayer identification numbers. So your business is taking a business deduction, which is going to reduce your taxable income for these amounts. The IRS, as you know, wants their money. They want to see that that income has flown to another company or individual's tax return, tax filing. So they're saying, okay, you've tried to get that W-9, you haven't. You have our authority to withhold some of that money and send it directly to us. So as the IRS, we get our share. So you've finished your 2020 transactions, you've done your year-end accounting review. You're going to run a vendor detail report. A lot of accounting systems allow you to indicate if a vendor is going to receive a 1099, so you can filter out just for your 1099 vendors. QuickBooks actually has 1099 summary and 1099 detail reports already baked into the system, so super easy to run. From those details, you're going to put the correct information on the 1099 forms. Check those taxpayer IDs. You want to double and triple check that because again, that's what the IRS is using to match up and determine that your business deduction is being reflected as business income elsewhere, and you're ready to go for filing. So we're going to take a quick peek at these because I know we're running close on time and I want to have time for questions, but this is what that new 1099 NEC form looks like. The left-hand side is going to be all of your name, address, and taxpayer identification type information. And the right-hand side is going to be the dollar information. As you'll see, you really don't have too much to do. Box 1 is non-employee compensation. And box 4 would be if you have withheld that 28% that the IRS has allowed you to do, you throw it right there. Again, we're not going to be talking about state or Commonwealth pieces today, but if you've had to withhold any state tax, it would go in, that information is in boxes 5, 6, and 7. The 1099 miscellaneous looks very similar to what it looked like before, just the boxes have been rearranged. Again, left-hand side is going to be your taxpayer identification and name, address information, and your right-hand side is your dollar information. The boxes that are typically used are going to be box 1 and 6, so rents in 1, medical and healthcare payments in 6, and again, any federal income tax that you've withheld is in that same box 4. And just to reiterate the deadlines, copy B of those forms have to be to your vendors by January 31st, 2021. If you miss this deadline, the IRS can impose penalties and interest for late filing. So we definitely want to stick to that deadline. If you're filing by paper, your copy A and Form 1096, you need to file by January 31st for the Form 1099 NEC and by February 28th for the 1099 MISC. If your reflection plan does get extended to March 31st, and keep in mind you can file for a month extension on the NECs with the 8809 form. You're definitely going to want to keep a record of these for your files. It's not unheard of for the IRS to send documentation or some type of letter if a taxpayer ID doesn't match up, so you're going to want to have what you officially sent to them. And also, sometimes your vendors come back to you 3, 4, 5 years later, they get audited and they misplaced their 1099s and they have asked for a duplicate copy for them. All right, so we're moving into the W-2, W-3 filings. And just very briefly, what are they? Your W-2 is going to show the wages and other compensation paid and the taxes withheld for the calendar year for each employee of a company. The W-3 is just that summary transmittal sheet that needs to accompany the W-2 when you're filing with the Social Security Administration. Your W-2s, they need to be completed and filed electronically or by mail with the SSA and provided to each employee by February 1st, 2021. If you are filing more than 250 W-2s, you are required to file electronically. Now, typically these forms are going to be prepared and filed by your third-party payroll provider. If you process your payroll in-house, you're going to need to prepare and file these forms internally. If you have an accounting system wherein you're using the built-in payroll function, this process is available to you, and usually it's pretty intuitive, but you do want to make sure you have various payroll reports, distribution reports, things of that nature from the year on hand to help you and make sure that everything's going in the right boxes from the system. And just so you know, I'm sure if anyone here has been an employee of a company, you know what a W-2 looks like, but there are tons of copies. There's 6 copies of the W-2, A, 1, B, C, 2, and D. And just for your information, A is what goes to the Social Security Administration. The copies B, C, 2 are for your employees. 1 is for the state, city, or local tax departments, and D is for your filing copy. Please note that copy A must remain error-free. If you make a mistake, you are to put an X in the void and start a new clean W-2. You're not allowed to cut, fold, bend, staple, paste, any of that on the copy A of the W-2. And you'll notice that it is always in red. Now, this is the copy that you will be filing with the Social Security Administration. And again, similar to the 1099s, boxes on the left are your name and address and taxpayer identification information. Boxes on your right is where you would fill in your wages and taxes withheld. We're not going to get into, how do we use box 13, what goes into box 14. We just don't have enough time in this seminar. If you do have specific questions on how to fill out W-2 offline and provide you the information you need. The W-3 real quick, if you have W-2s, you're going to be required to file the W-3. This is going to allow you to send the forms to the Social Security Administration. And you want to ensure that the total of the amounts reported on your quarterly filings throughout the year, your 941s, they need to agree to that amount reported on your W-3. Your W-3 again is going to show totals of all of the W-2s that it is summarizing. Those totals need to tie to the totals of your 941 filings. If you've already done that as part of your year-end accounting and reporting checklist, you're good to go. And just for your information, this is what the W-3 form looks like. Again, it's in red, indicating that it is for filing with the IRS, with the SSA. Again, you can't staple, cut, bend, tear, rip, paste, anything. It has to be clean and error-free. Matt, before we get into ACA reporting quickly, was there a W-2, W-3 question?
It just said, what are W-3s and 941s? It
Okay.
just asked what they are in general, yeah.
So W-3 is, again, the transmittal sheet for your W-2s. The 941s are your quarterly payroll filings. So each quarter you are required to send over documentation to various taxing authorities and for state purposes that detail out wages reported, tax withholdings, things of that nature, number of employees, and typically there's a tax payment that is due at that time as well. So our last section today, and we're going to just really briefly cover this, but ACA reporting, that reporting mandate is still in force for 2020. So as you may or may not know, U.S. employers that have 50 or more full-time employees are required to offer health insurance that has to be compliant with the details in the Affordable Care Act. These same employers must also file forms 1094-C and 1095-C to the IRS to show that they are compliant, as well as furnish this information to their employees. There's various things that your insurance plan has to meet to be compliant with the ACA. Typically there's definitely a minimum and essential coverage that you have to meet. There's a minimum value and there's an affordability type clause. that amount right now is 9.86%, but that does get adjusted based on the federal poverty line. Your support for this is going to be your wages and hours details by month, by employee, that you can run directly from your payroll system. If you're processing payroll manually, you should already have those in some type of spreadsheet or documentation that you can pull right from there. Your 1095-Cs are the documents that have to go to your employees by March 1st, 2021. Please note that that is extended. Typically, these have a February 1st due date. And the 1094-Cs and the copies of the 1095-Cs, those are the forms that you're filing with the IRS. If you're filing by paper, you have until March 1st. If you're filing electronically, you have until March 31st. And keep in mind that electronic filing is required for companies with more than 250 employees. Again, these reports are going to help prove that your company provided the right health insurance coverage, and as an individual, as your employee, they can then prove that they carried health insurance for the required months of the year. So key takeaways, year-end accounting, super important. The more effort you put into reconciling, ensuring your transactions are posted correctly, ticking and tying out to that third-party support is just going to help you with that tax preparation, ensuring that you are able to comply with any of your filings timely, accurately, and efficiently. You're just going to have that confidence. I can't say that enough. When you know that you have that strong support behind you, you can walk into a meeting with your lending institution, with your tax accountant, and you're like, I got this. I know exactly what's in my accounts. I know that my revenue has been scrubbed, my expenses. You need support? I got support for you. It's just a fabulous feeling. And your third-party individuals are going to feel that and just know that they can rely on the information you've given them. And as we went over, tons of reporting deadlines exist in January, February, and March. 1095s, 1094s, 1099s, W-2s, W-3s, your final quarter 941s, and those dreaded tax returns that are due March 15th for businesses and April 15th for individuals. The cleaner and more accurate your accounting records are, it's just going to help alleviate that stress. And that's what we all need, especially in today's interesting society. I think that's it. Do we have any questions?
We just got a couple things coming in. We had, a very positive comment coming in from Barry saying that he really appreciates this webinar providing an insight look into the complexities involved in having both quality accountants and attorneys is so beneficial. And, clearly we want to be here for that. And thank you for those kind words. Rod said small and independent businesses often use Schedule C. They pay suppliers for services that exceed the $600 threshold. Are they too required to file 1099s when they pay a supplier more than $600?
I'm thinking they are. I am not 100% sure, so I would like some time just to do further research, but I think since you will be taking that as a business deduction, the IRS is going to want to see that as income somewhere else. So yeah, I'm going with, I'm 97.6% sure that yes, you still have to file 1099s.
So it sounds like you do it for yourself, most importantly, so that you can support deductions that you've taken on your returns and
yes.
there's an audit. Right.
Do we have any other questions?
I appreciate these webinars. While everybody's thinking if they have another question, I'll fill some air here. This is good because if you're a small business owner, and you all are, this is going to be good information for you. But it's also good for you because it helps you better understand what's going on with business owners out there that you're engaging with on a daily basis, and you're trying to connect them with Legal Shield or with a business consultant. I mean, one of the things that you want to be as a resource for your customers to connect them with services and things that they need. But the more that you understand about business, the better able you will be to conceptualize the benefit of having Legal Shield or a connection to an attorney regularly or a business consulting firm regularly. You'll be better able to conceptualize that. The number one reason why people don't access legal services or consulting services is because they don't realize that whatever is presented to them, whatever situation that they're having, would benefit from that. That's really the reason. And so the more education you get, the better awareness that you will have, and you'll be able to connect folks in.
One of the other questions were, will all these seminars be at the same time? We are really going through the planning process for that right now, so we don't totally know, but we think that we're going to really stick to the 9 a.m. time slot, at least for the time being, as we think that those are fairly well attended. But we are going to be providing a survey. It's very quick, takes 2 or 3 minutes to answer the questions, and that would really help us to know what everyone out there wants to think. We have partnered with Mike and Legal Shield here, and I think that this is just a really good opportunity to hear what you think so that we know the best things that we can bring to the table for these future seminars.
Yeah, I see the comment that it's a little early for West Coasters. So, I think the last seminar that we did, right, there was somebody that clicked in, either from Vancouver or Alaska, and that blew Noel's mind.
Yes. Yes, it was like 4 a.m. or something.
And so their perspective might be a little bit East Coast perspective, and we might have to, tweak our time.
Sure.
So we'll probably try a couple other time slots, maybe even noon or, late in the day kind of thing, just to see what works for folks. And, hopefully we can catch a variety of folks.
That's wonderful. On our end, from Donnelly Bolin, one of the things that we really love is to be able to be seen as a resource. When you have issues and you have questions, you feel like you can reach out to us. Clearly, if you want to partner with us and actually help us, have us help you with your business consulting, accounting, bookkeeping types of needs, that's absolutely fine. But if you just have a quick question after you get the email from us about the survey, you're going to have our DBA communications email. So you have a way to reach out to us. We have a Facebook page, we have a website, we have a LinkedIn. If you want to connect with us, that's just another way for us to stay engaged. We're always here to help, and ultimately we want to help small business owners with some of their complexities and struggles that they're having so that we can help elevate everybody. So that's our motivation, and that's what we want to be here for. So when you have issues, you know who to come to.
We've curated topics for our seminars this year. And so, as I had mentioned in March, we're going to be talking about that tax elections for small businesses. Matt's forte is social media and marketing. So we're going to be doing a marketing seminar as well. We'll also be doing a seminar that talks specifically about classification issues, whether you have an independent contractor or an employee for small business owners. A lot of folks don't understand the classification issue, and it can get you into some hot water with the Department of Labor. And unpaid wages, unpaid wage taxes are personal liabilities for business owners, even if they are paid out of a business entity. So something that you'll definitely want to pay attention to. And then later on in the year, we'll be sort of touching base after the quarters to talk about things that you should be doing on a quarterly basis. And we'll do some year-end seminars on budgeting, right? Helping put a budget together and year-end planning for the following year. So a lot of things that are particularly tailored for small business owners. My hope is that not only will this be beneficial for you, for your own business, to help you connect with other business owners, but this is an opportunity for you to invite current and potential customers to an educational webinar that they will benefit from. That's sort of an easy connect. If you're looking for connect opportunities with your customers throughout the year, that isn't a salesy thing, where you're trying to be a resource, connect them into these webinars, because we're really curating the material just for them. So hopefully you can use this as an opportunity in your customer service model when you're regularly connecting with your business customers on a regular basis. Hey, I've got something that you might be interested in. Why don't you plug in? Okay, and they might thank you for it and get some referrals.
Mhm.
Okay, any other final questions, last call? All right, well, that's it. Thank you all very much for participating today, and we hope to see many of you on March 4th for tax status election.